Good morning, everyone. I'm Mark Phillips, and I'm here with Harvested Financial to talk about what's going on in the options markets today. So let's take a look at what's going on in the broad market and see what is happening in the major benchmarks. Well, we've got SPY off a hair. It's down 47 cents. When I made this, it's down about a buck right now already. IWM up a little bit actually, up to 223.50. We've also got the Qs off again. They've been selling off heavily. A lot of tech routed selling going on there. VIX is up a buck 20 to 24, and we have Bitcoin rebounding and fluctuating right around 50,000, trading 49,411 right now. That's up 914 since the last time we spoke. So markets are a little bit calmer. We saw a really big rally into the end of the day yesterday, giving back a little of that in SPY and QQQ, but overall relatively calm open here. So a lot of positioning going on this week. We're Wednesday, and people are definitely thinking about what's happened earlier in this week. A lot of headlines around ARCs and their positions moving around. So this has definitely got the feel of a little bit of that turbulence in the market. And that's partly why we're seeing the VIX continue to drift up, even though we do have some buoyancy across other markets. So interesting things going on today. But since today is Wednesday, we are here to talk about butterfly strategies. So I want to take a look at TLRY, and this is a name that we definitely enjoy watching here. It's fascinating volatility, and so we're going to compare some long and short butterflies and some of their different risk-reward profiles. So what's going on in TLRY? Well, we know that this is one of the big cannabis names. It's incredibly choppy out there in these markets, high implied volatility, which makes for some really interesting times to think about butterfly strategies. One of the really big things going on here, speaking of volatility, is just how astronomically high the close-to-close historical volatility. I think I saw a reading of the 10-day historical vol over 400. Now, a lot of that is because there was some huge price action last week where we saw a jump all the way up to 60 bucks, and now it's come back down. If you recall, about 2 weeks ago, we talked about the merger and the putting on a put spread, call spread swap between TLRY and AFA, just because of how big the gap was between these two names. So like I say here, the AFA merger is still continuing to move forward. We definitely have started to see these names converge in terms of price. So TLRY is trading right around 25.58 right now, and AFA is a little over 19. I'm sorry, a little over 18. So the terms of the deal are 0.83 shares. So again, that spread is definitely coming back to a lot closer to where the terms of the deal are expected. There's been some movement on the Canadian front in terms of the Justice Department there allowing the merger to move forward. They don't have any objections on antitrust grounds. So it seems increasingly likely. The company's just put out a website with a bunch of FAQs about how this merger will go down. So that is looking like that's going to continue to happen. Finally, TLRY announced some earnings results last week, and while they are still losing money right now, the latest results do suggest that there is profitability on the horizon by 2023. So some interesting things to consider here as we approach our different butterfly strategies. So I want to think about how we frame our butterflies, and I'm going to go ahead and pull up my screen share here and show you what I'm thinking. So get myself out of the way a little bit. So I'm not going to go for these Feb 26 options. Those are only expiring in 2 days. I'm going to look out about 9 days here. And I want to compare two different butterflies. Well, actually, really the same one, and think about that from an odds perspective on the amount that you will either pay or receive on the same butterfly and what that means in terms of risk reward. So if we're sitting right around 25.50, I'm going to do the 25.50 butterfly that gives us about 15% stock moves. And I'll tell you in just a second why I chose 15%. But going for a 15% move, I'm going to sell two of the 25.50s. And then I'm going to buy the 29s. So that gives me a 350 upside move. And I'm going to then buy the 22s to have like an equally kind of spread ratio here. So, this, this like $3.50 leg difference here represents, well, let's see exactly what it represents. It represents 350 divided by 25.50, that gives a 14% range, 13.7 to be totally exact. So I have about 13.7% on either leg here. And I did some looking at the numbers, and over the last 2 years, TLRY has landed within 15% of its current stock price 67% of the days. So 67% of the days, TLRY closed within 15% of its current stock price on a T+9 basis. So looking 9 days out, the 9-day forward price was within 15% of the current bounds 62% of the time. So of course, some of those big moves are going to be outsized, and we certainly see volatility, and that's why we have an implied vol that's trading this high around 140. But when we're using defined risk spreads, we can cap that extra move because the options price in the extreme cases here. So if we think about the fact that 62% of the time, TLRY will close within 15%, that's why we set our butterfly wings about that distance. So looking at the pricing here, I'm going to throw in a what if and expand that, and I will just move myself out of the way. So if we're looking at this butterfly here, this would be getting long the butterfly. We're going to pay about 91 cents to get into this if we trade this right here, right now. 91 cents on a $3.50 wide butterfly, 25.50 to 29 is $3.50. If we pay 90 cents, the most we can make is about 270 on that trade. I'm sorry, 260 on that trade. And so, here it's saying 251, but approximately if we were to sit right at 25.5, we would see our max gain of around $260 per contract. So we're going to pay about 90 to see a max gain of around 260. That's a little less than 3x, 2.7x or something like that. So risk reward, that looks pretty good. If we see it close right there, that's that maximum gain, and we have a gain range from 22.90 all the way up to 28.20. So we will be profitable anywhere in that range. That 15% range that we've seen TLRY close within 62% of the time. On the other hand, you might be thinking, wow, vol is really high. The historical vol is astronomical, like I mentioned a little bit earlier. This might be a situation where we want to go short the butterfly, long volatility. And what a short butterfly looks like, well, it gets its name because you are actually receiving a credit at the outset. So, we're going for the same strikes here, the 25.50, the 29, and then the 22. Oops, I'm sorry, I'm not going to buy that. I'm going to sell that. And, you'll see about the same pricing here. The only difference on the pricing is the fact that markets have moved a little bit. So instead of a 92 cent, we're looking at closer to 98 cents now. But this should look like the exact flip of what we were previously seeing with the long butterfly. Now, the risk reward is totally flipped here. It's that same 92, 98 cents that you're either buying or selling. But the difference is that you will lose all of that money, that $260. Well, really here, 250 if you go by the dollar amount. You assume that you collect a dollar on this. But if you will lose all of that money if it just sits right here. Your profitability range is the inverse of what we talked about before. So you need to see this move below 22.90, maybe 23, or outside of 28. Given the historical vol, that certainly seems like it's possible. That certainly seems like there's some directional gain. In this case, though, you'll only make the money that you received on that credit. So the only time you're able to realize that full profit is if we go beyond those levels. So you're risking potentially $250 here to gain $1, or if you go long the butterfly and assume that vol is going to come in, it's the exact opposite. Now you're upfront risking $1 to potentially make that 250. Now, some of the questions that come in here, of course, are, well, to make that maximum gain, it is going to have to sit exactly at that strike. So there's not necessarily a direct relationship between that max gain and the price you pay, because that requires a very specific pinning scenario. Whereas with the short butterfly, where you're long volatility, any movement outside of the range is going to pay on the spread. So some definite questions to think about here with the risk reward, but in these very high vol names, we're seeing 140 implied vol even if some of the close to close price action has been astronomical, there are good reasons to say, you know what, it might be a time to sell volatility even when historical vols are particularly high. But as with both of these spreads on the long or the short side, we want to think about comparing our defined risk to our defined gain and think about how that's going to help us set trade prices. Systematically executing butterflies is one of the best ways to capture volatility premium in the markets. Whether you want to get long volatility and stay exposed to potential movement, underpriced movement in the market, or if you want to get short volatility and take advantage of the overpriced volatility in the market, systematically doing that over and over again is one of the best ways to harvest that premium and that edge. It's not always about one trade. Some trades will be winners, some trades will be losers. It's about staying exposed to the options markets over time. And those are the systems that we're building at Harvested Financial for our clients to access the options markets. So tune in here every day, 8:35 Central, 9:35 Eastern. We're talking about the markets. We're talking about different ways to use option strategies to enhance your portfolio. Check us out on our Twitter also at harvested_DAFE because derivatives are for everyone. Thanks so much for tuning in.